Leaving behind fishing line and hooks at the spot you just fished ain't just bad for the environment, but it's a waste of money. That's money that could be collecting value in your life insurance plan. So while I sort through this mess, let's talk about cash value life insurance and how it works. There are only two types of life insurance policies to collect cash value. That's going to be your traditional whole life and your universal life. The latter of which is the one you hear most about in terms of infinite banking, tax-free retirement planning. It is a collection of your premium payments made over time into the policy. But depending on which type of policy you have, it works in two different ways. In a traditional whole life policy, the premium you use to pay is actually collateralized against the death benefit. So every dollar you put in premium is actually a dollar now less that the company has to pay out. You are literally paying down and purchasing your own death benefit over time. So after the company takes out their fees to cover you for that large benefit, what's left over after you've paid that premium is going into the cash account, and then that will receive some sort of smaller fixed interest rate like 2 or 3%. In a traditional whole life, and these are most commonly seen in final expense senior market world, because you are paying your coverage down with your premiums, you're actually having a smaller cost to be covered every year. So a higher and higher portion of your premium then goes into the cash value and compounds exponentially. Then you've got the Rolls Royce of life insurance, the universal life plan. In this example, we've got an index universal life insurance plan. This was started by a 35-year-old at $600 a month. Now you may say, wow, big price tag, but that big price tag turns into big cash return. The way the cash value in an IUL works is that your premium payments are charged a cost of insurance and a few smaller fees to get to a sub-account called the policy value. Now, the policy value is what gets credited in interest rate, and that interest rate in an IUL is actually indexed based off of stock market indices, when your average of about 6 to 8%. Now, in the first 15 years of an IUL, if you choose to cancel that policy, the cash you actually get back is going to be charged a surrender fee. And that surrender fee is the difference between the policy value and the cash surrender value. After those first 15 years, the two accounts mirror each other until you decide to take out money. Most people choose to do this through a policy loan. When you loan money out on an IUL, the policy value actually stays the same. It continues to accrue interest. The cash surrender value gets deducted by the amount you loaned, and if you passed away and the benefit needs to be paid out, they would deduct that remaining balance out of the death benefit. That's why these policies are so popular. You can accrue excess cash because of the indexing strategy, and even when you take that money out, still accrue interest on that money as if it was still there.